Welcome. Today, we're exploring essential trading terminologies. While the stock market may seem complex, understanding key terms is crucial for informed decisions, trend analysis, and strategy building. Whether you're a beginner or experienced trader, mastering these concepts boosts confidence and success. Let's dive in. A bull market occurs when stock prices rise or are expected to rise, driven by strong economic growth, high investor confidence, and increasing corporate profits. Investors buy stocks anticipating future gains. A great example is the U.S. bull market from 2009 to 2020, marked by steady growth in major indices like the S&P 500. A bear market occurs when stock prices drop by 20% or more from recent highs, often due to economic downturns or financial crises. Investors sell assets to minimize losses. A key example is the 2008 financial crisis, which led to a prolonged bear market with stocks losing over 50% of their value. A market correction is a temporary price drop of 10% to 20% from recent highs in a bull market, often due to profit-taking, economic concerns, or external shocks. It's generally seen as a healthy reset before further growth. For example, in September 2020, the S&P 500 experienced a 10% correction after months of gains. Liquidity refers to how easily an asset can be bought or sold without affecting its price. Highly liquid stocks, like Apple and Microsoft, have tight bid-ask spreads and high trading volume. In contrast, illiquid stocks, such as penny stocks, have wider spreads and lower volume, making them harder to trade efficiently. Slippage is the difference between the expected trade price and the actual execution price, often occurring in volatile markets or large orders. It can be positive, leading to a better price, or negative, resulting in a worse price. For example, a stock order at $50 may execute at $50.20 due to sudden price movement. Margin trading allows investors to borrow money from a broker to buy more stocks, increasing both potential gains and losses. If losses exceed a certain level, a margin call requires additional funds. For example, with $5,000 and 2.1 leverage, an investor can control $10,000 worth of stocks. Volatility measures how quickly a stock's price changes over time, using metrics like standard deviation or beta. High volatility means rapid price swings, ideal for short-term traders, while low volatility offers stability, preferred by long-term investors. For example, Tesla, TSLA, is highly volatile, whereas Duke Energy, DUK, is more stable. Support and resistance levels are key in technical analysis. A support level is a price point where buying interest prevents further declines, while a resistance level is where selling pressure prevents further price increases. For example, if Amazon, AMZN, consistently bounces back from $3,000, that price acts as support. Fundamental analysis evaluates a company's financial health, earnings, and growth potential. Key metrics include the P/E ratio, which compares price to earnings, EPS, which measures profitability per share, and dividend yield, which shows payout returns. For example, Apple, AAPL, has a P/E ratio of 30, meaning its stock trades at 30 times its earnings per share. Technical analysis predicts price movements using historical data and indicators. Key tools include moving averages for trend identification, RSI for overbought or oversold conditions, and MACD for momentum shifts. A common signal is the golden cross, where the 50-day moving average crosses above the 200-day, indicating a bullish trend. Day trading involves buying and selling stocks within the same day to profit from short-term price movements. It requires high volatility, liquidity, and quick decision-making. Traders use technical indicators for timing. For example, a trader buys Tesla, TSLA, at $900 and sells at $9 or $15 within hours. Swing trading involves holding stocks for days or weeks to capture medium-term trends. It relies on technical analysis and chart patterns. While less intense than day trading, it still requires active monitoring to maximize gains and manage risks. Value investing focuses on buying undervalued stocks based on strong fundamentals and holding them long-term. Popularized by Warren Buffett, it targets companies with solid earnings, low debt, and sustainable models. A classic example is investing in Coca-Cola, KO, for decades based on its strong fundamentals. The risk-reward ratio measures potential profit relative to risk in a trade. It's calculated as potential loss divided by potential gain. For example, a 1:3 ratio means risking $1 to potentially gain $3, helping traders manage risk effectively. Diversification reduces risk by spreading investments across different sectors, asset classes, and regions. This prevents heavy losses from a single stock or industry. For example, holding Apple, Microsoft, JP Morgan, and ExxonMobil spreads risk across tech, finance, and energy. The Fear and Greed Index measures market sentiment, with fear indicating bearish conditions and greed signaling bullish sentiment. Extreme greed can suggest a bubble, while extreme fear may present buying opportunities. For example, in March 2020 during the COVID crash, extreme fear signaled a potential market bottom. Mastering trading concepts is key to informed decision-making. Whether analyzing trends, placing orders, or managing risk, these fundamentals help traders and investors succeed. Whether you're a short-term trader or a long-term investor, understanding these principles lays the foundation for successful market participation.